Working. Great. Okay, let's kick off today's session. Hello, everyone, and welcome to Foulger Underwood's latest accounting M&A market update. My name is Kevin Reid, and over the next 40 minutes or so, I shall be asking questions of Foulger Underwood MD Keith Underwood. Keith, give him a wave.
Good afternoon, everyone.
All our delegates today. So the questions that we'll try and broach and deal with today will revolve around the M&A market for the accountancy sector in the UK. Our topics for this session are on your screen, or there will be in a second. And as you can see, we have latest deals. There's been lots of those, so Keith will do his best to round those up. We'll also discuss the impact and, or perhaps even we should say, the disruption to networks and alliances models in relation to the consolidators. We'll discuss potential developments over the coming months in the market. And last but not least, the good old practice valuations that we know are always popular. I'll stop our share screen. And I shall just go through some housekeeping really, really quickly. And for those of you who don't know, Underwood is a leading advisor to professional services firms, helping them with M&A advice through to succession planning, strategy, and leadership development, among other things. So please visit foulgerunderwood.com to find out more about us. Lastly, we will take questions. In fact, we welcome them. We do actually have quite a lot. In the last few sessions, we've had lots of questions through. So please feel free to use the Q&A button to send them in, and we will broach them as they arrive if they fit the flow of conversation. Otherwise, I will leave them till the end of the session. We've already had a question in for today from one of our registrants, which was around, will PE still be buyers in the coming years? So Keith will broach that later. If you have any questions that you deem sensitive or you'd just like to have a chat, please drop Keith a line at keith@foulgerunderwood.com. And if you're watching a recording of this, then drop a comment in YouTube or just send Keith an email anyway. Today's session will run to about 45 minutes or so. I shall share screen again, and I shall pass over to Keith to start us off proper, Keith. Will PE still be buyers? We'll broach that later. But first, completed practice deals.
Thank you, Kevin. Thanks for that intro and background. I suppose this is a series of updates we do, which are sort of turning out to be every 4 months of the year. So we monitor acquisitions, as it's our lifeblood, really, and transactions, and try and bring you salient issues and items, I suppose, which might be pointers to the future direction of some of the PE houses and acquisitions over the next year or even longer. So I think we start off with the completed practice deals. We've monitored since the last meeting, we've monitored somewhere around about 40, 45. I'm sure that's not all of them. I think the interesting parts coming out of that, we've had activities from the consolidators of TC, Assets, Zenodon, Evelyn acquiring something, Danes, Summer and More Kingston being some of the larger consolidators who are active in the marketplace at the moment. Zenodon doing a number of deals. Interestingly enough, we've also got some of the independents still doing deals and, in fact, increasing the number of deals as they sort of compete with the consolidators to grow their own size and scale for the future. So we've got Menzies having done a deal, Moore Thompson, WR Partners, Shorts up in Yorkshire, Crow, and Armstrong Watson, to name a few. And I think there are a couple of others we've missed off there. So they're the independents who are funding their own or offering acquisitions which involve perhaps buyout of exiting partners plus a equity swap for the younger partners coming into those independent businesses. So the market's been pretty active. I think the other salient feature here is the size of the deals. And this goes across the board, really, for consolidators and the independents. It does look as though we're looking at deals which are maybe sub 10 million in turnover, and quite a few of these around the 3 to 5s for various reasons. I think firstly that the pool of 10 million to 30 million practices, which were sort of major features of building groups such as Summer Group, have to a large extent been approached and decided already whether they want to remain independent or enter discussions for a sale. I think that's already taken place. There are fewer of them in the marketplace to attack or to target for the consolidators coming through. And of course, a lot of these consolidators are, if we look at 4 phases over the 5 years or 4 years of their involvement, a lot of these are entering phase 2 or phase 3 of their life cycle. And we will have a look at that later on. And we believe in, obviously, there's an initial amount of money on the table which has to be spent in the first year, 18 months, followed by acquisitions and integration. And then finally, in the last 2 years, the full scope of maximizing the EBITDA for the PE house before they do their flip. So naturally, we're in that second, third phase, which is most likely the odd large one. But generally speaking, what we're looking at here are deals that I've just mentioned between 3 and 5 million. There are a couple of outliers there, but they're in that sort of size. And I suppose people are doing add-ons to existing business. TC have changed their policy. It looks as though in the last 6 months that they're now acquiring 100%. Sorry, they're 51% investments that they've made generally have been given the go-ahead to acquire 100% of smaller businesses, which means they're trawling in the 2 to 3 million level for 100% acquisitions to boost the total, but they're being integrated within existing investments. And likewise, some are doing more of their spokes. They have set up their hubs, and now they're concentrating on the spokes and feeding in additional business from smaller practices that they're acquiring into the hubs they've set up in 9 locations through the UK. So I think that's quite logical in terms of the consolidators looking at smaller acquisitions. I think are we at a peak or a wave? I think I've just explained how we're going through that wave, and it's not necessarily peak or wave in total terms. It's the phase of those investments by the PE houses. It's an awareness of scale by the independents and those independents wishing to grow, and they see themselves differentiating themselves in the marketplace by providing ongoing independence, not the sort of PE driving fully commercial business models that PE offer, and therefore are being successful in attracting some smaller practices into their groups. I mean, see, the ambitions are quite strong, and even in the independents of sort of 40 million, 50 million and above, they are looking for significant growth. But that's not all through acquisition. That is market growth of 15 to 20%, which is very challenging for the next few years, perhaps. But it does in fact, challenging for the next few years, but it does in fact highlight that they do see scale as an important factor, these independent firms of whatever size. And there are quite a few smaller consolidators trying to do it through their own funding, internal funding, who want to grow from the 5 to 10 and from 10 to 20, and may then in 5 years' time wish to be looking at an exit to a PE house.
Keith,
So,
just as an outsider looking in, is the market able to absorb these number of deals?
well,
Is
I
the
think now
market big enough for it to continue?
yeah, well, I think that's a question we possibly answer later on in one of the other slides, but yeah, the numbers are declining.
Save it then. Save it. That's fine.
Yeah, I think the numbers are declining. I've put down here, we've got a number of people from attending from Ireland. We're quite close in the Irish market. That has been, as a smaller market, it has actually been approached fairly aggressively by the consolidators and by the independents. So that is perhaps offering less opportunity to expand dramatically over the coming years. Scotland likewise has had a number of larger firms picked up by the consolidators and independents, and a lot of that is now consolidated in with very few opportunities now above the 5 million level, particularly in the main Glasgow, Edinburgh belt. So yeah, I mean to say there are limited opportunities going forward, but and we'll deal with that later in this presentation. So going on to the second slide, Kevin. I've put this in because there's some interesting developments I feel within this network and alliance structure, which couples branding with consolidation. So, I mean, typically, historically, the networks and alliances give you an exchange of ideas between practices. Perhaps have an international membership which feeds business or refers business into London. And likewise, your international clients can be serviced in US and other locations where the network has representative members. So that's traditionally been the case. What has been skewed recently is, and we've seen a couple of people drop out of particular networks, alliances, because they've got internal conflicts, which is the second point I've got on that slide. So maybe the practice is quite keen to have one identity through a network. And the unfortunate thing is that maybe in one case, their financial services side, corporate finance side, has aligned themselves with a different specialization group internationally. And they've had to withdraw from the provisions of one network and look for another network. So the increase in service-driven line management has actually made the service lines look in different directions, maybe from the corporate, to obtain the best possible feed in an international network, which is going to develop their business in the UK. So I think that's one factor. But then you sort of have some examples here that I've listed in the third point, where there's some interest out of the US at the moment. And I think that will grow now, particularly with the election in the last few days, because I think some of the American banks and private equity houses will actually get a little bit more license to go out and be fairly expansionist with less regulation. So I think that might have some effects over here. But what we have to date, just to highlight these, is Grant Thornton, which, as you know, the US end has gone with private equity. The UK end has basically set up a bank to look at alternatives for the UK operation. They are entertaining the US end being one of those buyers who have reached the sort of final list. And they're looking at 4 or 5 of them, and we'll see where that goes. But I would suspect it'll most likely be the US end, which is private equity backed, investing in the UK entity. And that will put Grant Thornton into the private equity pot, but with a strong transatlantic presence. RSM last month announced that it was also going to look very closely at cooperation and integration, merger between their US operations and their UK operations. And they specifically excluded PE involvement. So this again is a move to bring together across UK, US businesses a much more integrated form of service. They think there's going to be significant benefits by cross-selling. And RSM has a non-PE model. Mazars, you may have seen their actual entity has been now called Forvis Mazars. Well, Forvis are a very large US-based accounting practice or financial services practice, because it gives a little more than just accounting. They've been talking to them for a number of couple of years. Mazars are, of course, French-owned. and they're the only accounting business which actually have umbrella profit shares around the world. So they're perhaps advanced on even the top four. And they've linked in with Forvis, but it's not an equity link. These are two separate businesses which are co-branded, but for I suspect reasons of PE exposure, they are not actually going to link themselves formally in an acquisition or full merger. So you've got that going on, which again drives US UK business. I've just entered a couple of others which have been in the press. Ecovis in the US was a very large US firm, Ecovis being the network. Markham was owned by a public company, which has now been divested to a private equity firm. And just to look at the change on that, there was a very big operation in Asia, in China, which dealt with a lot of Chinese state business, which was audited within that Ecovis group previously, which is looking to sell off to another entity now because it doesn't fall in line with the new arrangement. So all this brings about a little bit of change and a little bit of strategy change. And then we have Cooper Parry, who 2 months ago decided that they wanted to set up their own network. They announced it pan-European mainly, with a few other members externally. But seeing the benefits perhaps of, as a private equity entity, seeing the benefits of at least having business referred to it from outside. Of course, Cooper Parry was a PKF member and then withdrew from that about 3 years ago before private equity came in. So there's some interesting developments there, which I just think are underlying some of the trends in the marketplace. And when you get down to some of these alliances, you actually question, what is going on here? DFK, for instance, who actually are on conference at the moment, their UK conference. But DFK have got 3 consolidators sitting in there as members in the UK. They've got BKL, who only went in this year. They've got Shaw Gibbs, and they've got Gravita, all of whom profess to be members of DFK. And you're wondering how the DFK management are handling the independent members' aspirations within an environment where you've got some PE predators who'd be very keen to pick up those independents.
I
So
mean,
you've got
it sounds like a bit of a halfway house, Keith, between, the benefits of PE and being joined up and investment, and yet they're part of a network which is effectively, whatever anyone says about network versus alliance, they're both relatively loose.
They are relatively loose, but it's whether they can become more actually stronger as a group. And that's a very good point, because it leads on to the latest things we've seen is PKF and UHY separately, but taking global initiatives to cut out the names of the local entity and just adopt the name PKF. So where they have been joint, it used to be UHY Hacker Young, or it used to be UHY XYZ Letchworth, or wherever it was. Those are being dropped now to become UHY. And the obvious next step after that would be to be able to offer that to a private equity firm as an integrated brand structure, albeit in both those cases, the individual companies beneath them are locally owned within their territory, within their country. But it is a stepping stone. At very least, all you can say is it's an enhancement of brand to compete with some of what is going on in the marketplace through the PE houses as well, which
Yeah, it
certainly
is,
are
but as you
rebranding.
said, it is still in that kind of situation. It's separate deals. They're all independent deals.
They would be independent deals, and the drag on that for a PE house is really to question why you would go in. Just use UHY as an example, which has some 2-partner firms. It has some 10-partner firms in there, and larger firms, obviously, within the group in the UK. They are not necessarily the best bedfellows for a roll-up consolidation because of the size and different levels of expertise offered as members of a group. but at least the branding, which has always been a problem with alliances, and we dealt with a lot with the UK 200 group, and it must have come up 3 or 4 times over the years we were involved with UK 200. That is to drop the name of the local entity and just adopt the branding PKF, UHY, or whatever it is. So that sort of aspect is going on quite strongly at the moment, we see, certainly over the last 6 months, and it's certainly something to watch in the future.
Well, we're at the halfway stage, Keith, just so you know.
Yeah, fine. So if we go on to the next slide, I mean, I leave it, yeah, on to the next slide, which just brings up a number of points we see developing over the next 6 months. We think the next 12 months are going to be quite exciting in this area for various reasons, some of which I've outlined here, and I've just picked them up as key points, which you might want to take on board and consider in the next few months. But I think if we reconvene on this webinar, perhaps in March time, which is normally the time for the next one, I think we would have seen some of these materializing, coming to the fore, and a little more clarity in some of these areas as regards the future direction of travel for the accounting practices in UK. So the first one is, of course, the flipping. And we mentioned this before, PE firms are flipping. We've got 4 we believe will go in the next 9 months. There is still the response that they'd like to be first movers. And you can draw whatever conclusion you like from that in terms of the PE house wanting to be the first movers. Remember, there are, of the cohort out there consolidating at the moment, there are about 20 of them, a little more. Of that 20, you've most likely got some long-term holders, because we include ETL and people like that within that framework. ETL are a family office operation out of Germany, and they most likely are looking for a much longer investment in their targets in the UK than perhaps the PE houses, which will certainly flip within 3 to 5 years of their initial investment. So you have that going forward. You also have, when you look at these firms flipping, you put yourself in the PE house, which might be offered an investment in one of these consolidators. So you've got different scenarios out there. If you're a PE house sitting out there looking for an investment, you might be offered, and I'm not sure they are on the market in the next 9 months, but at some stage they will be in the next 2 years. Maybe Zenodin, which has 130 offices. Yes, it has a common brand, but it has 130 offices in UK. Some of them very small, and you wonder as a PE house, how can I take that forward? And if I'm going to pay X, which might be 13, 14 times EBITDA now, what am I going to be able to sell that on for? And what effort is it going to need to get us to sell it on for 16 times, perhaps, hypothetically, within 4 years? And likewise, you can look at Summer, which is an alternative. And I'm just saying all these are different. Summer has at the moment gone through acquisition of hubs. They've kept the identity of those hubs. They have provided some central back office, but they're looking for the hubs to basically manage and develop their own geographical areas. And again, that without a common brand must raise with the PE house, which is going to come in as an investor, some questions as to where that is going for the future and what they can bring to the party to increase the EBITDA. Then you have someone like Gravitar, made 7 investments. They've gone through in year 2 to 3 some major integration already. 7 acquisitions. They've changed the names to Gravitar, and they're pretty all Southeast based, and they will have been looking very carefully at maximizing their EBITDA for whenever they go, which might even be within 12, 24 months. And then you've got people like TC, who've got a portfolio of 51%. Most of their acquisitions are 51% equity, not full equity. And therefore, you've got a lot of minority interests hanging around with fairly small practices, some of them, within those businesses, and questions over future commitment and I suppose, continuity of the management of those individual businesses. So you've got all those different situations. So nothing will be consistently comparable. Nothing, you'll have some benchmarks when these people go to other PE houses. And I'm saying they're going to a PE house. They're not going to IPO. I've heard no one suggesting that they're going to go for an IPO, although I think Zenodin, that was the original idea on Zenodin years ago. But I think the rest will go to other PE houses, larger PE houses. Will this drag in US interest? I suspect it will, because they've got some of the larger PE houses out there. But it's really what's left on the table. If I'm going to pay 13, 14 times, and I need to get that, I need to be have a pretty good story that I can get out 16 times in a few years' time. And this whole evolution brings obviously to bear what value should be ascribed to accounting practices consolidated up, the longevity and sustainability of the income, and where the PE houses really see this for the future. I still think they will have money on the table. The typical PE house selling to a PE house will paint a picture that there's still consolidation to be done. There's still internal rationalization to be done. Both of those driving the EBITDA for the investors exit in 4 or 5 years' time. And that they will be, that they will critically be looking to paint a picture which is attractive to the PE investor. But at what level does this top out if you're only on a short-term 4 or 5 year investment cycle? So I think that's going to come to the fore in the next 6 to 9 months as the first few PE houses flip to other PE houses, and it'll be quite interesting to look at that. So coming down, coming down that list there, reconsideration of strategy would change. The next PE house will have a slightly different view of how it's going to drive the business through to to achieve its EBITDA growth. There could be a consolidation of PE consolidators. I mean, some of them have got ambitions to remain fairly small at the moment. Some of those 20, they might just be looking to build to 40 or 60 million. And some of the larger ones might therefore be looking at them in terms of buying them out. However, it raises the same question for the future as to if you bring them in, there is most likely an ethos, because they're all different, bit of an ethos management change. That's disruptive for clients. It's most likely disruptive for staff as well. And it's how that is managed going forward. So there are question marks on that. I think the Tilney, Smith and Williamson, in the last 3 months, we've had a situation where the PE house behind Tilney and Smith and Williamson have basically said they're interested in exploring a sale. And that sale, from what we read, is a split. So the whole idea initially was that Smith and Williamson would provide an office next to every Tilney office around the country and provide the shoulder to shoulder financial services that where Tilney were offering wealth management services. So that it would look as though that strategy is now being questioned, and the direction is most likely to sell off what we understand is the Smith and Williamson business separately to a PE house, and perhaps divorce the two, or have an arrangement relationship between the two businesses, but not perhaps manage them in the same way. So that's perhaps a PE concept, as to bring the two together, which perhaps has not achieved the successes it thought it would, and is now being looked at in a different way for the future.
I mean, just to jump in there, in terms of when we talk about the consolidators generally being disruptive, trying to change things, to have something like that not really work out is a little bit scary and does kind of call into question how disruptive the consolidators have been with their investment. But again, I say that as a journalist, I kind of,
as a journalist, you might see an opportunity for an article there, but but I think the point is here, if it doesn't work, decisions are going to be made much more quickly in this sector. That's not wrong. That is just commercial. And any business will have the right to invest somewhere, decide it's not working, and perhaps change direction. But of course, it's a little alien to the accounting profession, although I'm an accountant myself. But we are terribly reluctant to change. And that sort of flexibility is not innate. It's not second nature to us. And I think most accounting practices historically are still traditionally run and would most likely try and manage their way out of it rather than do a breakaway, which most likely will happen here. I think the most recent one for the UK budget, the next point is the CGT. Are we going to see people coming forward as the CGT tax goes up by 4% and then 4%? Is it going to accelerate some sales coming to the market for people who want to get out maybe in 4 or 5 years' time? Are they going to bring it forward? There might be an element of that, but I think when you look at it at 4%, and it could have been far worse, I think you're still looking at, if I earn money for the next 3 years and take my profit share, the 4% is not going to be significant. I can't go back to the old lower rate. I'm going to have to pay the 14% or whatever it is, and then it's going to go up to 18%. But if I've got income coming in, so be it. I think it's something that can be absorbed. Not ideal, but can be absorbed, which actually throws, particularly for smaller practices, it throws the decision back on when do I really want to retire? What can I put up with? And when do I might get a little bit more out, less out in the capital at the end, the net capital, but when do I really want to retire? Because I've got a reasonable and should have a reasonable income coming through in the meantime. So I don't think that's going to be a major factor, although I know a couple of parties have sort of said, oh, well, we're going to have a real build of sales, business sales in the next 2 years, but I can't really see that necessarily. So the other aspect is, we mentioned at the start, the independents are still seeking growth and looking for mergers. We're doing a lot of consultancy work, and happy to do it for anyone listening in, on trying to get the strategy right for independent firms going forward as they divest from present owners to the next tier down. It's a matter of funding, it's a matter of fundability and servicing that funding. If, of course, you've got goodwill recognition. If you've got custodianship, it's a much easier solution. But the goodwill recognition, we've got a few suggestions out there as to how that can be adopted.
Can I just jump? Can I jump in very?
Independent.
Sorry, Keith. I'll jump in very, very quickly. So, for those of you watching now, Keith and I produced a really, really excellent video around what being independent means in the current climate, what that means for being sustainable going forward. Please drop Keith a line. We have that hidden up on YouTube, and we will happily share a link to that video that we produced about a month ago or so. So please get in touch with Keith, drop him a line. It's a really, really good session that we had.
Yeah, it's a good point, Kevin. Thank you. And we had some very good feedback from that as well, in terms of we obviously hit a few we hit a few challenges for the participants, which they responded on. Going down that list then, so the independents are still there, and there is increasingly a response. If we move to a practice which is looking to sell, it is looking in some way to engineer, wants to have the younger partners in a larger entity. They have all been approached. Most practices over 2 million have been approached by the consolidators, and therefore the partners have developed a view on whether they want to sell now, whether they want to sell in the future, or whether they wish to remain independent. And there's an increasingly spontaneous response, I suppose, that from some people, that they do not want to get involved in private equity and want to remain independent. And it's those people who are going to be gravitating towards those independent firms who, apart from growth rates of organic growth rates of perhaps 12 or 15% that I mentioned earlier, will also be looking for add-on mergers from appropriate parties, particularly with good quality fee bases or portfolios, and with good younger partners in tow. They'd be very attractive. So the other aspect that's going on at the moment, which we're involved in as well, is because we cover what I call peripheral activities to the accounting profession, add-on service consultancies, the PE houses, and now the independents, mid-range independents, are all looking at areas such as cyber, financial analysis, IT boutiques in particular areas which integrate with accounting firm needs, and possibly for accounting firm clients as well, and looking at sideways at evaluating some of those small boutique consultancies so it can be brought on board as an investment and provide a differentiation perhaps from other practices when they approach their clients and sell an additional service. So there's a bit of lateral going on here. I mean, so if you look at Danes as a good example, I'm sure Richard won't worry mentioning his name. Danes have actually done a couple of good acquisitions within the accounting sector, but they've also added on some very specialist areas. And actually, I can't remember what they were though, but they were sort of international VAT consultancy. There was an IT consultancy in there, and
Cooper
also
Parry as
internal
well.
audit
Cooper Parry, some
consultancy.
interesting IT services businesses they've brought on board.
So those sort of things are a bit on the lookout now for a certain size of business. And I think the last one is differentiating the brand. What has certainly come out of the PE involvement is that the brand has been changed. So Gravitar has come out and consolidated its acquisitions under Gravitar brand. LB Group, a very small consolidator, not very small, but doing about 40 odd million or whatever. They have recently, in the last 2 weeks, it seems, announced a change of brand. Assets, of course, is a change of brand to create something totally new. Cooper Parry looks as though it's going to become CP, which is perhaps not quite as imaginative, but CP. And I assume they're going to use that as a brand. But I think this rebranding comes with the byline below it, which is sort of is quite often trying to dictate a different model to the businesses they've taken over. So it's trying to say something different, whether it's the major supplier to service SMEs throughout the UK, or whether it's a more technical aspect. They're using this rebranding to pull together the client base, the headcount, in other words, the employees, so they're attached to something a little bit different from the individual goodwill of the practices that have been taken over, and to create something in the marketplace which is a little different. Of
We're
course,
5 minutes. We're 5 minutes off of 45, Keith. So just
fine, yeah, I know I think we're doing well. So of course, cynically, I would say, accounting has a range of services it can offer, and that range hasn't really got significant scope to expand laterally. As somebody said to me the other day on cyber, we were talking to them about cyber and selling cyber, and they just turned around and said, well, how am I going to be confident that my 10 partners are going to go out there and talk to their clients about cyber opportunities when actually their knowledge of this service is so limited, and they don't necessarily have the inclination to take it on board. Anyway, that we've covered that in a different way, but it is, there are certain things that accountants can offer. Yes, of course, it will broaden, it will get deeper in depth as well, and AI will come in, and that's another area which people are interested in, as to how AI is going to access these businesses and change them. So I think for the future, there will be activity, but I think the broadening of it exponentially is not necessarily on the cards. So you're basically building and vertically driving service lines, which are most certainly apparent at the current time. So I think that's where we go for the next slide. We're really repeating where we are in this life cycle and re-emphasizing it in this presentation, that the private equity have brought forward, some of them are brought forward as first movers, and they're moving in years 3 and 4. And it's becoming evident now, talking to some of them, that the increase in the EBITDA through rationalization, by increasing prices, by cutting out offices and perhaps some restructuring some of the staffing, they are looking, certainly two of them are looking for 50% increases in that year 4, a 50% increase in EBITDA from year 3. Some of it through the acquisitions coming through and full year accounting, but in other cases through increasing pricing, getting rid of certain non-core clients or non-performing clients, if you like, so margin evaluation. So it's nothing that we're not really expecting. The EBITDA, if you talk to a private equity house, the EBITDA is king. It has to be king. That's what they're based on. That's what they're going to sell out on. And therefore, there has to be a force through in year 4 and 5 to maximize that area. However, they are very conscious that they have to have something in their proposition for the event, for the purchaser, the other PE house, that there are additional opportunities for consolidation and or additional opportunities to save cost. And that's where it's going to become quite interesting, as I said earlier, over the next 12 months. So if we move on to the next slide, Kevin, which is the last slide. So we always leave this to last so people don't leave us. So the value of the, I mean, see, we're not showing major changes here. Independent deals are still going through at 3, a few at 3 now times EBITDA, or 1 times to 1.2 times fees. And they're still getting deals going through there. Lockup is for the vendor's account, so debtors of work in progress get funneled out to the vendor when they're realized. Compared to PE deals, 5 or 6, if anything, there's been a firming up on this area, but I think that's because they're approaching that 3rd and 4th year in the cycle. I think that's haven't really done any in-depth analysis on which consolidators are pushing up those multiples. But yes, it is creeping up. It's not declining. Let's put it like that. It's certainly not declining from 5 or 6.
Are they generally 100% sales now? Okay.
No, it depends on the model of the consolidator model. I mean, so you've still got larger deals for TC are still 51%. ETL, although they're not a strictly consolidator, they are again doing 51% deals at 5 or 6 times for the business which is being sold. So we've seen certain ones go through at 7 or being offered 7 times, but they are larger practices of which there are fewer, as I mentioned earlier, and they are possibly very successful practices with for some reason the niche they're in generates a significantly higher profitability. So that's where we are at the moment. The consensus PE flip has not really changed either. It's most likely hardened at this 10 to 13 times. So when the PE goes to another PE house, I mean, say 2 or 3 years ago, there was mention, we're going to get 16 or 17. The only benchmark we've really got is the asset sale, which is not really public, but we think it was about 30. They sold 50% 18 months, a year ago now, because it took a little time to complete. And that we think went through at around 13, although they were trying to push for 14, 15. So we think that's going to be the consensus area, which of course provides the concertina. So if it's going for 10 to 13, they're going to offer the individual practices they're buying. They're quite happy to offer 5 or 6, maybe 7, but they need the differential between the two deals, the arbitrage, if you like, between the two deals to be effective to give them their profitability. I'm not sure whether the carried interest change in accounting, again, it wasn't perhaps as large a change as was mooted in the UK budget, whether that will actually make the advanced sales and make sales of practice more attractive. In other words, the consolidator is doing more business. We'll have to have a look at that perhaps at the next session. But yeah, there are things changing in there. But this will be the benchmark. We'll get 2 or 3 deals in the first 6 months of next year, PE house to PE house, and we will be able to surmise from the limited information they give us what values they went out at. And that will provide, therefore, the cap, if you like, on future deals going forward in the next 12 months.
Keith, we're at 45 minutes.
So that's where we are. That is the presentation. We're very happy to take questions. I mean, say there was the question you raised earlier, Kevin, which I did see, which was about will the money be there in 4 or 5 years' time? I suppose I haven't really answered that because I've basically left a question on the table as to what's going to happen to the PE, to the second investor in these consolidators. How long are they going to hang on? Are they going to hang on another 4 years? And are they going to be able to get out at 14, 15%, whatever it's going to be for the future?
Keith, we have had a quick question, which is, I think, a very fair question and one we have been asked before. Just could you, how are you defining EBITDA? I guess in
Um,
relation to these valuations, what does that mean?
yeah, we usually go down as a sustainable EBITDA. So you take the profitability over perhaps 2 years, look at the future as well, and bring that in if you've got some good figures. Exclude any exceptional items or anything that might be termed below the line in the old terminology. Take those out, look at the trend. Hopefully there's a growth trend there. And then take out a partner cost. So you've got all your salary costs for your fixed share partners, and you take out a notional salary cost for the partners ongoing. From my perspective, that's always what do you have to pay in the marketplace to generate the top line fees that the partners or directors or shareholders or whatever they are actually contributing. So I suppose in London that it's coming out at about 100, anything between 120 and 150,000 for each partner. Specialist partners might be higher if they're generating materially different higher fees. Sometimes we've seen it as low as 80,000 on a consolidator model. They'd be offering the partners 80,000, but they are usually for out of London and rather more remote locations.
We've had a couple more questions in as well, so we'll just
Yep.
broach it. I think we'll just broach these ones together. So we have been asked if the PE house, it's the doozy, this one really. If the PE houses can't find investment, will some groups fall apart? I think we might have had this discussion ourselves. And are practices that are run by PE houses gaining or shedding clients? And I guess I think we'd kind of say that is there a net gain there, perhaps?
Yeah, but they're two very interesting questions. I think taking the second one first, there is anecdotal evidence, and I suppose we see about or talk Zoom-wise to about 20 practices a week, just to update on their strategies and things and catch up with where they are and see whether we can help them consulting-wise or transactionally. The feedback is that they are picking up an increased level of, or they're seeing an increased level of clients coming to them from consolidators. This is anecdotal, but I have no reason to discard it. So that means that clients are falling out, and this is coming. It's coming increasingly, I think, in that third and fourth year when the consolidators are rationalizing and pushing up fees. If that's their move to increase EBITDA in those ways, then of course clients are going to be a little unsettled. They might have a relationship change within year 2 and 3. And are therefore looking elsewhere for more bespoke hand-holding, if you like, from a partner level independent firm. So yes, you've got that happening. You've also got some fallout from price increases as well. So particularly at the bottom end, I mean to say you take on a group of clients which we analyze, and sometimes we analyze them as price sensitive, non-price sensitive, depending on which sector they're in and what their history has been with that practice. If you've taken over a lot of price sensitive clients who for various reasons are in sectors which are not, where you can't pass on effectively price increases, and you're trying to increase your accounting and advisory fees, then of course those people are going to be more they're going to be more pressured to look for at an alternative source of that service. So yes,
Couple
that
more
is
quick.
increasingly happening.
Couple more questions, Keith. So one, I think I might ask this person to send you an email, but they basically asked our partners who sold out to PE finding that it's meeting their expectations. I think that may well be a case by case kind of situation, but maybe that's a conversation for that person to drop Keith a line. I think he'll perhaps go through some of the war stories with you.
Can I have
Second,
that first question and get the very first question, Kevin? Because we don't
yeah,
think we
partners
answered.
who sold out to PE finding it's meeting their expectations.
No, the one before that.
Uh, we've kind of will PEs fall apart? Our firm's going to fall apart.
Well, we've seen an experience in Asia because we've been in Asia dealing with PE houses in corporate services sectors for a little while. We have seen two fall apart in Asia, which were in the corporate services side, very, very aligned, I suppose, with what we're talking about here in accountancy, but that was more corporate services, tax, international tax, multi-jurisdictional. Two of them have fallen apart and sold off to other PE houses for various reasons. They won't all be successes. They won't all achieve the aspirations that they were originally set for growth and size. And there will always be issues of, I think, continuity and providing resources, appropriate resources to service those larger clients, corporate clients within the portfolio, and motivating those people to stay and provide a good service, which compared to the independent has a much more sustainable model in terms of client relationships and servicing.
What I will say is, I know we've had a couple of people leave, which is absolutely fine because we're over our 45 minutes. We still have a couple more questions. If you want to stick around, we'll stick around. We'll answer these questions. If you've got to go, thank you very much. Video will be archived. Right, back to these questions. Um, are you seeing an obligation to achieve future EBITDA growth alongside the agreed multiple? Or are deals based on maintaining current EBITDA only? I.e., I guess if you're I don't know whether that's about those that have sold out or those that are still within the organization from the.
Yeah, we've seen examples of both, but they are in very specific situations and customized situations. It's always difficult to establish a benchmark, future benchmark for EBITDA, because the situation is there. We always feel there has to be a strategic integration, whether that be change of offices, staffing, service line driven rather than partner driven. And all that creates additional cost, which means that the EBITDA gets skewed. You can't really get back to comparing EBITDA to the day of completion EBITDA on which the consideration was measured. So usually what we do is the EBITDA is the measure up to the date of completion, and that's what the financials are there for. We then flick back to most likely looking at a margin situation, gross margin, or a turnover situation on which the future is measured. And of course, the turnover from the clients that have been acquired is a much more stable situation and can be measured, give or take, additional services and the rest of it, for making adjustments to the consideration. So yes, but ultimately it is EBITDA. I mean, so the PE house wants it driven by EBITDA. They have, with their management team in the consolidator, targets for the EBITDA, and they it is critical they are met.
One last question. Level of working capital that PEs are typically paying on a deal, considering debtor WIP lockup for many firms can be a large number.
Just repeat the front of that, the first part of that.
So what level of working capital are PEs fronting up? What they pay in?
What they're basically including it. They are offering you a multiple of 6 to include the balance sheet. If your balance sheet has 180 days of debtors and work in progress, effectively, I mean, see, commercially, they're not very interested in that. They're much more interested in someone who's got 80 or 90 days. But it is taken out of that multiple of 6. So the actual goodwill is a smaller figure, if you understand what I mean. So we take the multiple of 6 times the EBITDA. That's the consideration. But if you want to get at the goodwill value, you have to deduct what is going to be left in the balance sheet in terms of the value of the debt as a work in progress. I don't think there's no sort of main benchmarks to say it has to be at this level. We've just had one deal fall through because the clawback the PE house wanted to apply to the non-recovered 60-day and over debts at the end of 2 years was actually going to be excessive because they were going to apply a multiplier against it as well to adjust the consideration to the vendors. And that deal fell through. So, yeah, I mean, see, the one thing the PE houses do not want to do is they don't want to make an acquisition and then have to continually fund the working capital through further injections into that individual deal for an ongoing business. So they do want, and we've seen some very detailed calculations about averages over 9 months, over 12 months of working capital to arrive at the adjustment they're going to make. But yes, I don't see that 120 would exclude a deal. Anything above that usually means that it's not quite being run correctly or commercially if you've got more than 120 days of debtors and work in progress. But yeah, I mean, see, the ideal thing and what they're going to be doing in the future is to push it down to 90 days or less.
Yeah.
As fast as possible because they want the cash flow, they want discipline with the clients in terms of payments, and they want discipline internally in terms of work in progress billing.
Okay, that's our last question. We're hitting an hour. I appreciate everyone's trying to get some food. We're starting to lose a few people. Thank you very much, everyone, for joining us. As you can, thank you for answering all those questions, Keith. All Keith's details are on the screen, so feel free to drop him a line if you'd like to talk to him about your firm and its direction of travel. Please get in touch with Keith about our recent video on sustainable and profitable existence as an independent firm. Follow us on YouTube for more videos. Visit foulgerunderwood.com to find out more about us. We're also on LinkedIn, X at Foulger UK. And we're also on Instagram every now and again. We put a little Instagram post up. Lots of other videos. Please check them out. This video will be archived for those that registered and available for you to access again. Thank you, everyone, for joining us. Been a really interesting hour. Thanks again, Keith. Thank you for watching. See you all soon.
Thank you, Kevin. Thank you, everyone, for joining.